All right, guys, what's going on? So I want to go over a particular setup that occurred yesterday. And this is going to include a feature that, a couple times I've said is not as significant in crypto markets, and I'm referring to the initial balance. But in this case, and I think in certain cases and in certain contexts, it can be a valuable thing to pay attention to. So first and foremost, the area that we're going to be talking about is right after yesterday's open. So you could just tell in the price action alone, it looks like something is coiling up. When we're talking about the initial balance, we're talking about this line, this line right here. This is a tight initial balance. This is a wide initial balance. What we're talking about by default is the 1 hour period after market open, so the 1 hour range. And you could change this. Some people will change it depending on what market it is, to be either just a half-hour period or some hours. You could change it to a 2 hour period. For the most part, I think the best use case of it is from either 30 minutes, 45 minutes up to an hour. I have mine set to an hour. But again, this is the aftermarket open. This is the range of those first two TPO periods. So if I have it set to an hour, it's the first two TPO rotations. So if we just open up this one right now, you'll see that it's this, right? So this is the widest first candle. And if the second candle went up slightly higher, rather the second rotation went up slightly higher, the initial balance would be greater. So if we look at that initial balance versus an initial balance like this, first two half-hour periods, one, the high of that one's there, the high of this next half-hour period is there, and then we've broken outside of that initial balance in this case. So you weren't confined. Whereas if we go to the day prior, much wider initial balance, and we were within this initial balance, which was the high up here, the low down here, we were within that for what looks like about 3 hours afterwards. So there's different ways that traders will use these across different markets. You could take certain plays, whether or not the initial balance is tight or it's wide, begin to ascertain whether or not we're going to have, a strong impulsive trending day or a more range-bound day, or, whether or not the opening drive takes us outside of the initial balance, and we have a one time framing type of day, or whether or not there's a failed opening drive and the market fails to maintain course in one direction and then comes back through the initial balance. There's plenty of different applications that you could see, and that some traders in Blockroutes have shared before. But I think that in crypto there's less use cases than there is in, let's say, something like equities, where there's an overnight, a cash session. With Bitcoin, you have a 24-hour market. So it's really just, the market is closing and then immediately opening. There's nothing that took place in between. There's no overnight gap. So what I say is, the initial balance matters in certain context. You could have an initial balance that is tight, and we have a breakthrough initial balance either to the upside or to the downside. It looks like it has conviction to start, and then we end up creating a more balanced range day. And then you can have an initial balance that is very wide and then go on to trend hard in one direction for the rest of the day. And, those two types of initial balances, if you're just looking at, the market profile 101 interpretation, more often than not, those initial balances would imply the inverse. So I think that initial balance is useful when you're applying it in certain contexts. And one of the ways that I've gone over before is looking at, let's say you have a significant daily level. So let's just say, for example, that, the market has closed through a significant low. So let's say the market, let's say in this case we closed through here and we didn't close there, but we closed down here. And then you had an initial balance, right, that's ultimately going to develop through a significant daily level. So imagine if, let's say, for example, I'll just draw this out. Here is a significant, well-defended resistance over time. And then we've had a candle close through. Well, the initial balance of the following day is going to give you a good idea as to what the participants think of with regard to that significant candle close. Okay, because ultimately the initial balance is going to be part of the next day's open. And what you do see is, let's say this is a really significant weekly level and you have a daily candle close through there. You could pick up early on an immediate sign of activity based on that daily candle close And you might initially have an opening drive that ultimately leaves you with a very wide initial balance and then goes on to be a trending day. If anything, this is an example of an initial balance that leads to a day that might not be expected when you have, a wide initial balance through an area, and that's because you're paying attention to that area's open through that significant level. And it turns out, the first half hour of the day we shoot up pretty high and maybe go on to continue. So this is, you're essentially paying attention to the first hourly period after the open through a significant level, right? Which in that case, I would want to actually see that there's a strong opening drive. So the example that I'm going to go over, it's actually a case of a really tight initial balance, which does result in a really strong trending move. But it's more than just the initial balance, right? So what I'm going to talk about is yesterday's open. So just applying off of the basic, oh, the initial balance is tight, the initial balance is wide, I don't think that that's adequate enough. I think what you want to do is see how long you've spent within the initial balance if it is a tight initial balance. So we're coming off of a series of pretty tight, semi-balanced days, and we're getting tighter and tighter over the course of this structure. So a few things you could look at to determine, whether you're getting tighter. Well, obviously your average sub-period rotation size, right? So we're decreasing over time. So we go from 652, 525, 573, 469, 363. So we know market conditions are tight. The volume value area range and the TPO value area range. So in terms of dispersion, how wide these value areas are, you could see that up until yesterday morning, it had spiked, right, and then begun to tighten again. So sorry, I'm drawing lines through it. 900 from 2600 down to 800. So things are tightening up, right, from a volatility standpoint, from a value area standpoint. And, we're always going to look at price action as well. What we have is two very tight days, right? We have an inside day setup, and we have what is ultimately a pretty balanced distribution between these days, right? Individually, again, might not be perfect. You have a shelf up here. You have a poor low down here. So you do have levels that you could see some sort of imbalanced activity if you revisit them. But what we're going to focus on is this initial balance. All right. So how yesterday opened with respect to the 2 days prior, knowing that we're essentially beginning to bottleneck or tighten up. So the initial balance, again, is the first hourly period. If we open up this initial balance, you could actually see that we spend 5 hours within it, right? So 5 hours within it. Most of this activity, you can see if you flip this, almost fits like a key right within here. So it's almost like we're filling out this little bit of inefficiency that occurred within a semi-balanced structure. So semi-balanced because it is not symmetrical, but you can see that, it's not, most of the activity is within the value area, right? Most of the high volume nodes, right? Most of the large spike is within the value area, which obviously is the case. When you're looking at the point of control and the most participation, it's going to be in the value area. But just in terms of the distribution, most of this, we would say over the course of this structure, if you flip this on its side, gave you a somewhat centralized, we'll say centralized structure, right? Most of the concentration is focused on the center of it. So all you have is really this little inefficiency. Over the course of the 3 days in this tightening period, you have a point of control that we are able to maintain, right? We are able to close with relation to our point of control above, right? So we have prices closing above the point of control, prices closing above the point of control, right? And then ultimately the third day, which is the tightest day, still able to close above the point of control. So you're setting up with some type of balanced structure, right? You know that things are tightening up. You have an inside day, and you're maintaining where most of the risk from just a VPOC standpoint is coming in. Previous initial balances, you'll see that you're not going to have you're going to spend, a lot of the times you will spend, clearly an hour within it, but outside of that, you're going to have some type of opening drive, or rather, you're going to have some type of attempt either through the upside or through the downside. And then you might go on to range, right? You might have continuation, but you're going to have some type of attempt outward, right? It's unlikely that you're going to, stay within the confines of the initial balance. Okay, that should just be kind of clear. It's the first hour of the day, right? You'd have a tremendously tight day if that were the case. I don't think there's any case where you're going to have that. if you have a case where you have a day that's inside the initial balance, right? The moment that you get an acceptance through that, that is clearly going to be a high probability breakout play, right? When you see acceptance though, because in this setup, you're actually going to see that we have a false break and then you don't have acceptance, and really that false break leads to continuation in the opposite direction. So we have an initial balance that's very tight. It's within prior day's value. We have an inside day structure. Things are very tight, and you have 5 hours within the initial balance. So what we're going to do is go to the actual candlestick structure and just show you what this was looking like. This is market open. This is the high, right? This is the low. Okay, so ultimately what we're looking at is the market spending the next 5 hours within the open, high, and low between that initial balance. In this case, it's a unique structure because it's perfect for a breakout, right? What you have is actually a volatility funnel that's forming. So just to go over this real quick, this on its own is not a perfect setup, right? This is not its own, it's not even a setup yet. But you're getting the prime conditions that you would want for a move, right? So we know that we're coming off of an inside day. We know that we're, let's say that you're 4 hours into this, right? You're 4 hours into still maintaining that initial balance within the more balanced structure that we've come off of, and you see that price is beginning to form this sort of pennant on the low time frame. And this on its own is, it's just a pattern. But what you have to understand is what this means, right? What this means for the traders getting involved here. So within the first hour of the day, we're stuck, right? Within the next 4 to 5 hours of the day, we're stuck within this range, and there's been no poke above whatsoever, even a prior high that's developed. So if this is the initial balance high and this is the initial balance low, if you poked outside of that, you're getting the move outside the balance, right? But what I'm saying is throughout this structure, what we're doing is forming this volatility funnel. So traders are getting involved, and what we're seeing through this, okay, instead of going on XO and messing everything up, is if you go on this period, you'll actually see that towards the tail of it, open interest is increasing. So we're seeing that there are traders getting involved at the highs and at the lows, anticipating a break, and there's no resolve through any of the prior highs and lows. So what this allows is for a ton of stops to accumulate without interrupting any previous stop level. All right. So what you have is, and I like to call this, it really becomes a minefield, right? As soon as this begins constricting, okay, this is a stop cluster, potential stop cluster, right? Areas where the market came reversed, just the most obvious areas where you're going to see there was interaction, and likely there's going to be risk and liquidity on the other side of that. Risk defined, liquidity on the other side. Okay, the market comes back up to this level, and again, this is just 101 going over volatility funnels. Market comes back up to the level, never takes it out. Instead, you have the market turn here, and again, what it allows for is another buildup of this liquidity. I don't want you to think of, buildup in liquidity as if every time, there are traders that are, getting involved here, placing their stops right above, and then what you have is this perfect cluster of stops declining over time and perfect cluster of stops rising over time. Just think about each time that the market bounces off a level, it's higher at the lows, lower at the highs, and what it means is that there are more people getting involved yet that have no reason to get out yet, right? They haven't been forced out of position. Okay, they haven't had any kind of adverse movement. What's happening over time within the initial balance is price is just funneling, right, to a very fine point. And it's odd, it's funny how fine it actually becomes right here. It almost looks like there is some type of hidden order iceberg just absorbing all of that activity right there. Okay, so we have a very clear volatility funnel forming, and this is 5 hours into the initial balance. And again, remember, it is coming off of a very tight last 2 days structure. So we have that inside day structure. So in this case, okay, there's a couple different setups that you can go off of, all right? When you have a volatility funnel like this, okay, so let's just define the inside day structure. So the inside day structure is here and here, all right? So we're going from open to the high of the, we're going from open, this is the initial balance, I'm sorry, I said inside day structure. The initial balance is from here to up here, all right? So first hour of the day, all right? So really right here. So this is the initial balance range. Okay, so that is a lot of times if you're this long into the initial balance, 5 hours into it, confirmation through, right? Acceptance through is a no fade trade, right? So in this case, You're having acceptance either at the high, but you could have very well had it at the low. When you have this type of funnel though, it's not necessarily important that you wait for that type of confirmation. What we already know is that we have a very tight structure forming. 5 hours into it, not only were we within the initial balance, but we have a volatility funnel forming and we have an open interest increasing over time. So what we know is traders are getting involved right here, and it's the same concept of getting flat-footed in the middle of a range. These traders are just walking into this because it's prime area for liquidity in the center. It's easy to get into position over here and anticipate a break. And what you have is, again, no one that's been tested, right? At no point were any of these lows tested. So what you're looking for a lot of the times with this is you're looking for acceptance outside of the last turning point that was developed within the structure. So, the entire way we're going through, again, the entire initial balance, we're within here. We're looking for the move that is going to take us outside of this, and fortunate enough, we have a structure that is flagging perfectly within. So it's likely that the move that breaks the flag is going to break the initial balance, right? So more often than not, this structure as it's moving sideways, again, accumulating these positions that haven't had any trouble yet, when you do force your way out one side of the structure, you're going to cause that one side that's offsides to cover, correct, and you're going to have, a larger move through that ultimately takes you outside of the balance, right? We're looking for a larger breakout. So defining the trigger for this type of volatility funnel, it comes down to the last highs, right? Ultimately, what we're doing when we're defining this is saying, okay, the defining features of the volatility funnel is that it keeps making lower highs and higher lows. So as we get to the point, the last thing we're doing is really just marking off where the last points of the funnel are, right? And you're looking for, okay, we're looking for the break through this high, or we're looking through the break through that low. Okay, even if you just had 2 points in this structure connected, okay, if we were to just connect these 2 points, let's say, all right, and then connect just the top side of this structure, what we're ultimately looking at is a very clear break through one side of this. Okay, don't get lost on, is this perfect? Is this perfect? That's not the point, okay? What you can see is that things are clearly coming to a head, right? And right now behind the camera, I'm forcing my fists together, right? They're clearly coming to a point where there's a lot of built up energy. You're going from kinetic to potential, all right? So a lot of the times with this type of structure, all right, and with a breakthrough in initial balance, you'll see a failed move, right? So you'll see a sort of fake out. When we're looking for the market to confirm through, I don't know why I use that instead of this again. When we're looking for the market to confirm through any one side, or even if we're looking for the market to confirm through on the break of this, we're not just using the high and the low in this case. What we're doing is saying, okay, there's a really strong case for a breakout now because we've spent the last 5 hours within the initial balance, right? And we have an inside day structure that's already setting up, and this is filling this inefficiency right here. So we have a really strong case to be made for a breakout to occur because we've spent 5 hours within the initial balance, and in this period, you have open interest going up. But you can't just you don't want to just define the setup based on that, right? You want ultimately, as a trader, what you ultimately want to do is have a well-defined setup that is, substantiated by evidence and also, best possible entry, right? And sometimes the best possible entry means going down to the lower time frame and seeing that you're forming some sort of volatility funnel like this. Now, the footprint is, again, a very useful tool to look at to see acceptance, right? To see whether or not something is going bid or ask, right? So ultimately, at this break of the low, we could have very well said, okay, this is going to be the move that takes us down, probably takes out one of these lows, right? And our focus right now is on the lower time frame. Okay, the higher time frame trend with Bitcoin and these positions is clearly we're in buy the dip mode. But we're looking for the acceptance through what has been a defining feature of this funnel. When you have acceptance, all right, so we're going to go to that period. This is the funnel, okay? When you have acceptance through, you're going to want to see that sellers get really active, all right? Aggressive sellers get really active through the move. So multiple times within the highs and at the lows, we're accumulating a lot of volume, right? We're building up all of this pressure. Okay, again, you have a good amount of activity going on at the bid, even at the high and the low of this last period within the funnel. When you finally do get a break, what you ultimately want to see for any kind of continuation, same concept as continuation acceptance through the highs, is, if we're looking for the high to break and hold, we want to see that the volume is getting aggressive towards those highs and the market is able to close at the high. So, it's not necessarily a good sign when you have the market that you have a price that breaks through a level, you have a lot of volume transacted up here, and then we're trading back down somewhere down here, right? We're at X, we had millions of contracts at the high. But in the case of acceptance through a level, you still want to see that either way, you want to see that there's aggressiveness towards that end. Instead, what you get is you get a breakthrough. So you get like this false break, false break, and then towards the low end of things, right? Towards the lows, selling just drops off, right? So we're down at 90,000, 70,000 contracts. It's not like there was a jump on pylon effect that you would want to see after some type of funnel like this is broken. And a lot of the times you're going to see this. You're going to see that the first move outside of, same thing with patterns that are really obvious. A lot of the times you're going to see that the first move outside, if there's no immediate response and immediate follow through, it's a failed break, right? More often than not, they're going to be failed breaks. So instead you get the failed break here and price immediately claims back within this level, okay? Immediately upon claiming back within the level, you're seeing that these levels that didn't have that much selling, they're beginning to go bid, right? The market is beginning to go bid, meaning that there is selling that's coming in, but now it's able to maintain a higher level. So, here you have what is less than 1 million contracts able to move price, from here to here. And now we have more volume coming in at the high and price is able to hold higher. So this is just what a normal transition would actually look like when you have a failed break. You have an exhaustive move that's attempting to move through, right? Price does not commit, right? There's no, sellers do not commit through this. There's not as much volume. Price is now trading higher. And when you do have the selling that's coming in, it's not moving the market nearly as much, okay? More often than not, you're going to get a pattern that looks like this. You'll have this volatility funnel form. And when you make a concerted effort through one side, usually these patterns occur like that, all right? So when you have a market that is going to end up ripping to the upside, a lot of times you're going to see that it leaves you with a structure like this versus the obvious patterns that are funnels that end up breaking to the downside, right, are ones that look like this. They break up, there's no follow through here, right, and then we end up ripping through and you start to see that most of the aggressiveness comes in on the opposite side of this. So a lot of the times in markets in general, you'll have fake outs, okay? So what you see though, that is one of the most clear signs is that in the last turning points, right, so the last highs that we established, so just making our way down this funnel, right, so we're talking about the last highs and the last lows that we established. So if we're looking at just these lows down here, you wanted to see selling commit through there, right? At least you would want to see that it's absorbing. So there's no ask either, right? So you could see that the pressure that we have, the buy pressure, leaves us with these little gaps either way, right? Excuse me, not even picking on the wrong candle. You have these pockets down here. It's not like I am trying to draw, I'll use the, here we go. You have these pockets down here that meant that there's no ask even following this down. So it just shows you there's not as much interest to sell passively or aggressively. Okay, so we're below the low, we don't commit through the low, but now we're back above after yanking back. Okay, we're back above one of the more recent highs. So again, what this is just one of the last highs within the structure, right? So this whole general area right here, all right? So we're back above one of the more local highs that was a defining feature in this funnel. Remember, don't get lost on it being perfect. It's not laser tight, all right? Market is not liquid in that, it's not perfectly liquid in that sense. But what you're looking at again is what you want to see is now market when it breaks above that it goes bid. All right. So focus on the fact that you have one, less volume down here, moving price more. Okay. Now the market is on the other side of this. Now price is on the other side of this funnel. And now for a much larger amount of selling, price is able to hold. Okay. The moment that you see that you're breaking outside of this level, let's say that we broke to the downside, right? Let's say that in this break to the downside that this area went offered, okay? So we have too many pockets here. There's no area that really went offered on the break of the low, all right? So if we're looking at this area going offered and then we were able to trade below that, so let's say that, we saw 3 million contracts here. If you see 3 million contracts traded there and then prices maintain that level, then that's probably acceptance, right? You're probably going to maintain the direction of that break. Whereas when we break above the upside, now it's going bid, all right? And instead, what we're immediately doing is breaking above, going bid again, breaking above. You have the aggressiveness that is starting to pour into the market, right? you have those large orders that are starting to hit the tape. And now, keep in mind, this is refining it on the lower time frame, but what this can do is help substantiate the case through that break of the initial bounce. Okay, so if I go back to the initial bounce now, and we'll just put a line here. Where's my line? Horizontal line. Here's the initial balance right there. Okay, and now you see where the initial balance is. So all of that was a helpful piece of it, or that was helpful rather information to pay attention lower so that you can maybe get into the trade slightly earlier, right? You see that over here, okay, now price is going bid and it's holding, right? We had that failed breakout at the low. The initial balance trigger for the break through the initial balance, if you're looking for that setup, is higher, but you know that price is going bid lower. As soon as you start trading higher, price is going bid right under. Okay, you have the aggressiveness coming in. It's just more, it's very obvious at that point. I mean, it's not late because a lot of the times traders will just take the trade through this break. Okay, you don't necessarily need to, play the volatility funnel lower and look for those signs within the funnel. A lot of the times when you have this constriction, this type of move will result in a one-for-one move, right? So you'll have a move that is more often than not equal to the mouth of this structure, okay, breaking through the high. So you have the initial balance high over here, right? We see that price has gone bid down here. We see that upon the move up here, price has gone bid. And remember, more often than not, when you see that the market is making a strong move in one direction, so we have this slight impulse from 7,550 up to 7,825. When someone sells that aggressively, that typically gets revisited. Okay, you don't often see that traders get to aggressively sell this, for that kind of clip, and price going to reverse from there. More often than not, what we would look for maybe the signs of failure, it would be a ton of volume at this high, right? So we get a ton of volume at the high, at the offer, at the ask, and then price is suddenly starting to drift back within the previous structure. So these are just ways to refine a setup like that. Okay, where you have, again, we have a structure that is very balanced. Okay, we're coming off of a very balanced period. We have an inside day structure. We're filling out this inefficiency, and we're spending a lot more time within the initial balance than we would ever normally spend within. So we're 5 hours in, going on 6 hours into this. And another feature to pay attention to is that this initial balance has a width of $800, right? So within the first 5 hours of the day, our range is $800, okay? Whereas the entire day, if you looked at something like the 4-hour ATR, so we'll just go into the 4-hour ATR, for example, just pull that up. So ATR, so if we go back there, and then we look at ATR, and we're back down here, the entire 4-hour ATR leading up to this is well over $800, right? So we know in many different ways, and this is just how to really make a case for things being really compressed. And you have to remember what this is doing. Patterns like this, okay, patterns like this on their own mean that you're forming a great deal of pressure, right? You're building up a great deal of pressure. It's the same in physics, right? You're trying to force all of this energy into this point, okay? Now, that on its own is useful. That when you're seeing open interest is useful. And that knowing that you're coming off of a very balanced structure and you're still stuck within the open, okay? Again, stuck within the open, haven't exceeded the open range, okay? The initial balance range, going on 5 hours into the day. There's just a very strong case to make for a play through this, okay? If in this case, a trade like this, what you're looking for is the extension, right? And a lot of the times the extension is going to be back to revisit a local high, right? So, this is at the value area low, right? Excuse me, value area high of previous day. You have this imbalance here, so you would look for, more than likely you revisit an imbalance like this, meaning this ledge. You're going to have an explosive move through there. So I would say that in this case, ultimately my target from this is going to be previous day's highs within this larger range, right? Rather than just, yesterday's high. Whereas if we had the break of the low, right? If we have the break of the initial balance low, you're still within value, but I think more often than not, when you build this kind of energy up, you're going to revisit yesterday's, you're going to clean up yesterday's low. You're looking at ultimately what has been the range of the last, you're going on 3 days, but the last 2 days. So high, low. Okay, so the RR in that case is favorable towards the high. So you have to look at it like that as well. You know, you're seeing this setup begin to take place, and you have a favorable setup in terms of risk reward. And when you're looking at a structure like this, there's a lot of defining features that you're saying are validating the structure to begin with, taking it, right? So the high and the low of this on their own, if you're looking at defining the position, I would say, yes, you could get away with placing a low below that stop, right? Revisiting the high, and the risk reward there is over 1.5 to 1, right? I would think, though, you can go with a tighter stop, right? Clearly, the defining features of this funnel get tighter towards the end. So after you have a failed breakout, right? After you have this tightening structure, okay, so tightening over time, and you have this failed breakout, as soon as price begins to form this support, if you're getting long here, there's no reason for it to revisit, okay? So again, if we're just going to go off of the highs of the prior day as a target, and let's say that you see price go bid right here after it has a fake out, and now we're trading back above a previous level within that volatility funnel, you know, you're targeting these highs, or even these highs. You could take multiple trades through this, right? So your entry here, targeting those highs, and you could place a tight stop in this case because you're saying that you had this fake out, right? This is going bid. Price should not fall back within here. There's no reason for price to fall back within here. If it does, you know, the trade is not, the basis of the trade is for it to be explosive, right? If you're not getting an explosive, you know, an explosive move, then the trade thesis is just, it's not there, right? It could be there in a different setup, but if you're looking for that breakout play, you know, you could either use a tight stop there or, you know, a more conservative stop below the fake out level. Okay, you know, more conservative means that you're taking less of a position, but there is a case to be made for taking the lower stop down here. And my point is, you know, you don't have to go all the way back to the beginning of the initial balance to place your stop below there, right? Because you have multiple targets here. You have one target, prior day's high, but again, as I said, since you're in a range for the last 2 days, there's a case to be made for this being a much more explosive, larger play, right? Filling out all this structure. But you could place the tight stop, remember, because you know that since this structure was that we did have this volatility funnel, if it's going to choose a direction out of there, right, you should see a significant move quickly. Okay, defining a stop on the other side of this makes sense. All right, because we're looking for this to resolve and commit in one direction. Same concept as defining a stop below flag. Right, when we're playing breakouts on these lower time frame flags, when we talk about taking the break of the high, right, longing the break on those 3 to 5 minute time frames and placing your stop below here, that's because there's no reason for the market to revisit this. Okay, your trade is based on a breakout. Right, if it's back there, it's not a breakout trade. Okay, so that's that, guys. Hopefully that has been useful and informative. If you have any questions, as always, feel free to ask.